Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'm a senior financial advisor that works closely with Stuart Weems, and I'll be filling in for Stuart again today whilst he enjoys a hard-earned break. What I'd like to talk to you about today is buying property inside super, or owning property inside super, which naturally has to be within a self-managed super fund. So look, it's an appealing prospect for many when they're thinking about entering into it because of the tax-friendly environment of super. So whilst you're in accumulation phase, you're working career, you would only have to pay 15% tax on rental income, net rental income, and only up to 10% capital gains if you were to sell the property during accumulation phase. But if you held on to the property until retirement, it could allow you to potentially pay no tax on rental income or capital gains if the self-managed super fund was fully in pension phase. Now that's a pretty appealing prospect to many, particularly if you're in some of the higher tax brackets. However, there's some important considerations that I think you need to be aware of, and I'm going to go through them today. But one of the key considerations that I want to sort of elaborate on a little bit is what we call the liquidity trap. Get into that in a minute. But look, before I get into it, I just want to say that I don't want this podcast to appear that we are negative or against buying property inside super. That's not the case. But the point is, we just want to make you aware of the key considerations and make sure that it's done right. So let me just first start by giving a little bit of a backdrop on buying property inside super. So I feel like, 10 years ago, it was much more popular then. A lot of people back, you go 10 years ago, were setting up self-managed super funds to go and buy properties within it. You don't see it as much these days. I mean, modern day, like right now, this year, we don't really see too many people buying properties inside super. I think most of the people that have them, they bought them, 10 years ago. So it's gone out of vogue a little bit. And look, part of the reason for that is because borrowing money inside super is significantly more difficult than it was 10 years ago. In 2018, during the Financial Services Royal Commission, the big four banks stopped lending to super funds. So now it's left with only smaller banks and some second and third tier lenders that operate in the space. Interest rate wise, so to give you an idea, the typical interest rate for an SMSF loan currently sits, and there's a lot of variance in this, but on average sits around 7.5% as an interest rate. And at the time of recording this podcast, the RBA has held the cash rate at 4.35%. So 7.5% interest rate, that's roughly at 1% higher than an investment loan outside super. So you're probably going to pay, 6.5% for an investment loan if it's held outside of super. So there's a bit of a premium that the banks put on it, and that's something you've got to be aware of. The other thing to be aware of is lenders typically require a lower loan to value ratio. So it's usually around 70%. Sometimes it can be 60% when inside super. So just to explain what this means, people would know that you typically need to front up a 20% deposit when you buy property outside super. So a 20% deposit means an 80% loan to value ratio. So having around a 70% loan to value ratio inside super, it means the investor's got to contribute a larger deposit. On the lending front, you just got to be aware as well is that holding debt within super is more expensive on an after-tax basis than holding debt outside of super because the negative gearing benefits are much lower due to the lower tax rate inside super. So I guess this is the flip side of having a tax-friendly environment of super is that the negative gearing benefits aren't as good. So for holding debt, the interest cost inside super, you're going to get a 15% tax deduction. But for example, if someone was in the top tax bracket, their interest deduction would be up to 47% on the loan if they held it inside their own name. So there's a big difference there in terms of the after-tax holding cost of the debt. The next consideration which I want to speak about, which I think is the consideration that's often overlooked by many investors, and it's the one that I wanted to talk to most today, is what we call the liquidity trap. So look, once your SMSF enters into pension phase, so once you've retired and you convert from accumulation to pension phase, you're required to withdraw a minimum pension payment from your super fund each financial year. So some people won't be well aware of this, but just for background, so these payments, they're calculated as a percentage of your total super balance and they're tiered according to your age. So how it works is if you are under 65, you've got to withdraw 4% of your super balance. You're 65 to 74, 5% of your super balance. 75 to 79, 6% of your super balance. 80 to 84, 7% of your super balance. 85 to 89, 9%. 90 to 94, 11%. And then if you're over 94 years old, you've got to withdraw 14%. So if you think about the average rental yield from a residential investment property is typically between 2 and 4%. They all vary, but look, I think typically between 2 and 4%. And then there's also, this is before property expenses, and then SMSF running costs. So if you think about that, if they started at under 65 at pension phase, there's a 4% withdrawal they've got to make. If they're 65, there's 5%. So without any other assets inside super to draw upon for the first pension payments, a liquidity issue is almost going to arise immediately. And what this means is it forces you to sell the property. The nature of residential property is that most of the return is provided by capital growth, not by rental yield. And so if you think about it as well, because the pension payments are calculated based off balance of your super fund, well, the capital growth is just going to drive up the balance of the super fund, requiring you to take out more. So look, some people might be fully aware of this and they might be comfortable with the fact that they need to sell their property as soon as they enter into pension phase. This could be their plan. After all, because, the sale of the property would be capital gains tax free once they've commenced pension. And, in their mind, they would have hopefully enjoyed many years or decades of capital growth before selling the property. So what's the problem? I think the problem here is that being forced into selling a property within a relatively or quite a specifically short period of time, it's risky. It brings in market risk. So look, you might get lucky with the timing of the sale. It might time the property market just perfectly, but really relying upon that in your retirement plan, not a great idea, and it's a little bit risky. So if you think about it, over the last 40 years, the Australian property markets have gone through flat cycles, typically lasting 8 to 9 years, and then they go through growth cycles, typically lasting 9 to 10 years. Therefore, it's not ideal to find yourself in a position where you need to sell a property within a time frame shorter than at least 10 years, to my mind. So for example, you could hold a property through an 8-year flat cycle with minimal capital growth, very stagnant, in the lead up to retirement, and then could just be, theoretically the property market's just turning and it's looking like it's entering into a growth cycle and there's a lot of tailwinds behind it, and then you're forced to sell the property right when the property market's beginning to turn into a growth cycle. That's not a great outcome. So really, the takeaway here is that the longer you can hold the property through into retirement, or overall even before retirement, but then especially into retirement, the longer you can hold the property, the better your chances are of achieving adequate returns. And it's never a great outcome being forced into selling. It's not a good outcome from a timing perspective, but also the other thing to consider as well is people just tend to think that you can just sell a property whenever you want to. It's not always the case. So anecdotally, I've got a few clients that are trying to sell properties at the moment. A couple of them have given up. They're just not getting any bites on the property. They've listed it, they put it on the market, and they're just not getting any interest or any reasonable offers. And really, if they wanted to sell the property, if they had to, they'd have to take a huge discount on the property. They'd drop the price massively to get someone to come in and buy it. I mean, no one wants to do that. And some of these clients are, they're selling properties. They're outside of super and they were selling them for other reasons, investment reasons, strategic reasons. But luckily, they don't absolutely have to sell it. They've got other things they can draw upon, and they just thought, two of them have just thought, well, okay, we're not getting any offers, that's not working, the market's not very good at the moment, we're just going to put it back on the rental market. And they've just leased it out. I know one client's just leased a property out for 2 years, another one's going to put his back on the market for a 12-month lease. So you've got that option outside super, and there's no way that any of them wanted to take a huge discount on the sale price. But sometimes properties just don't sell. It requires a buyer to come along and buy it and pay reasonably what it's worth. That often doesn't happen, or sometimes doesn't happen. So what should you do about this? How do you manage the liquidity trap? The answer is pretty obvious. You've got to build up a portion of liquid assets within your super fund. So assets such as shares, bonds and cash. You've got to build up something around the property inside super. Simply paying down the SMSF loan, that's not going to improve the cash flow very much for most people because of the example I just gave before. I mean, the rental yield's still probably going to be lower than the minimum pension payments in the first few years. So paying down the loan's not a good call. In fact, it's better to, as I'll get into in a moment, build up some liquid assets around the property and even leave a little bit of debt, because it's going to be having those liquid assets to draw upon is going to give you time frame. So to understand how much of your super fund should be invested in liquid assets, I've run some calculations for you based off a simple scenario. So let's say someone retires at age 65 with a total of $1 million in their super fund, including a investment property worth $800,000 and a share portfolio worth $200,000. So in this case, they have 80% of their super balance in property. Let's assume the property has a rental yield of 2.5%. It's got property expenses that count for around 30% of the rental income, and the property appreciates at an average rate, a capital growth rate of 7% per annum, compounding annual growth rate of 7% per annum. I'll also factor in land tax of about $2,000 and say $1,500 for accounting and compliance costs for the super funds. So under these assumptions, the person would be forced to sell their property within just 6 years. However, if the asset allocation were adjusted to increase the liquid asset portion of the super fund, this time frame naturally extends. So for example, if the property instead made up 70%, they would then need to sell the property within 9 years. If the property made up 60% of the super fund, they would need to sell within 12 years. If the property made up 50% of the super fund, they'd need to sell in 15 years. If the property made up 40%, they'd need to sell in 18 years. And if the property made up 30%, they'd need to sell in 21 years. So I believe that gives you a bit of an idea of the amount of liquidity you need in order to buy enough time. So look, of course, there's many variables involved with individual properties that could affect the time frames. So of course, some properties have higher rental yields, maybe up to 5%. They might also have lower expenses than what I've included in my calculations. The other thing as well, commercial properties, they can generate rental yields that are, quite high. Some I've seen up to sort of 8% with minimal expenses, because often a lot of the property expenses are forwarded on to the tenant. So that would obviously extend the time frame as well. On the other hand, the other thing, lower capital growth from the property, which obviously no one wants, but this would extend the time frame from the property needing to be sold, because it wouldn't drive up the balance of the super fund and therefore the pension payments as much. Before I just go on, I've just touched on commercial property there, and I just wanted to make mention of it. One strategy that we do see quite a bit is business owners buying the business premise through their super fund. Look, I think that's quite a good strategy. That's got really good merit to it. They're typically they're commercial properties, those business premise could be like an office building, or it could be a warehouse or a medical clinic, that sort of thing. Look, I think that's quite a good strategy, assuming that the client can still build up liquidity and they're not having to go massively into that property. They can still do other things inside their super fund. Really, the benefit of it, just to quickly explain, instead of paying rent to someone else, you're paying the rent to yourself, and then you're receiving the rent in your super fund at a very low rate. So you're only getting taxed 15% on the rental income, and it's typically quite high with those commercial properties. They're quite high yielding usually. So yeah, I think there's merit to that arrangement, but it all has got to fit in. It's got to stack up as an investment on its own legs. It's got to have capital growth potential as well, and it's got to work within the broader plan of the super fund. One option when you're sort of approaching the asset allocation is to maintain some debt in the property. So to leave some debt, leave some leverage, not repay all of the debt, to allow yourself to increase the investment in liquid assets like shares. So this approach works. It helps. It extends the time frame considerably. So if we were to refer to the situation before where someone had an $800,000 property, no debt, and $200,000 of shares, so 80% of their asset allocation in property, if in the lead up to retirement, if they chose to leave $200,000 of debt owing against the property, instead allocate funds towards their share portfolio, so they increase the share portfolio to $400,000 but left $200,000 of debt against the property, well, this would extend their time frame from 6 years to 9 years in which they'd need to sell the property. So really the key takeaway here is more liquidity generally means more time. A little bit of debt is okay. So just to summarize my takeaway from the calculations that I conducted through this exercise, my takeaway is that leaving some leverage on the property is acceptable. Obviously, it's better to have no debt. If it's paid off, that's great. But leaving some debt is acceptable if it allows you to then increase the allocation to liquid assets. And in terms of the allocation that you need to liquid assets, you need at least 30 to 40% of the super fund in liquid assets by retirement, and this should provide you with at least a decade in which you can strategically divest of the property and choose when you want to sell it. The final point that I want to make about being forced into selling a property is that property is different to shares in the way that, shares are publicly listed, and, a unit of shares is exactly the same. Like you could sell units of CBA shares and buy them back 2 years' time, exactly the same units, albeit at a different share price, but the units in themselves are exactly the same. But property is different because every property is unique. And sometimes it can be a real shame to sell a property. So there could be some really sort of unique characteristics like a historical or heritage value to the property. It could have views of a landmark or ocean, could be one of a kind in its street due to its style or architecture or all these sorts of things, or it could have sort of personal connection as well, perhaps. So look, being forced into selling a property like that could also just be really disappointing for a client because they don't want to get rid of it. It's unique and they're never going to be able to get something like it or it specifically back. So I guess that's another, just a downside. All right, I'm going to jump into some listener questions now. As Stuart's mentioned before, we've got a lot of these, so let's try and get through some and I'll help Stuart out with them. Okay, so the first question is from Jason. Jason writes, my question is regarding the off-market transfer of shares from my trading account outside super to inside my SMSF. These shares are currently trading below the price I purchased them for. Will this unrealised loss also be transferred to my SMSF if I do an in-specie transfer, or should I sell the shares first to realise the loss against my income tax and then do a concessional cash contribution instead? So, Jason, let me just first explain for the listeners what an in-specie transfer is, because that's not a term everyone's sort of fully aware of. An in-specie transfer basically means you're transferring the ownership structure of typically shares, transferring the ownership structure of them without actually selling them. So in your case, it'd be they're in your name as Jason, but you don't have to sell the shares, but you're kind of just transferring the ownership structure inside super. Under that arrangement, it's still a change of beneficial ownership. So if you're moving inside super, outside super, into a trust, into a company, anything like that is a change of beneficial ownership, and that is a CGT event. So will the unrealised losses be carried into your SMSF? No, they won't. You would take that loss in your own name, and then therefore in that instance, because you're going to be taking the loss, I think, depending if what the shares are, if you think the shares are great and you really want to own them inside super, then you could keep them. The benefit of doing in specie transfer rather than just selling down to cash is it just reduces the transaction cost. That's really it. Otherwise, it's the same as selling down to cash and then buying the same thing back inside super. So, I think there's not much to the transaction cost. I'd really think about, do you love this particular shareholding that much that you'd want to then go and buy it again, exactly the same thing inside super? Because the tax implications are, it's kind of like you're starting with cash from scratch. You've mentioned a point here about, should I sell the shares first to realise the loss against my income tax? That doesn't work. It's a capital loss. So you can't offset capital losses against income. So capital losses can only offset capital gains. So you have to wait until you've got a capital gains in your personal name. Capital losses get carried forward indefinitely. If you ever have a capital gain in your name, you'll get to use them eventually, but it doesn't offset your income, afraid. So up to you. Your call there, Jason, but I hope that information helps. The next question here is from an anonymous listener. The anonymous listener, I think, is a lady, so I don't want to make that assumption, but in any case, she writes, I'm 50 and my husband is 60. We have a home in Melbourne. It's a long-winded question here, so I'll try and sort of summarise this a little bit. We have a home in Melbourne worth $1.5 million, no debt. House on Mornington Peninsula worth $1.4 million, $600,000 of debt. They do a bit of Airbnb, they use it a little bit, and they get about $35,000 of rental income from it. They also have an apartment in Melbourne, paid in cash, owned through the partner's company, so it's worth about $500,000. It's on Airbnb, about $35,000 of income. They've got $500,000 in a self-managed super fund. Of that, it's all property, $500,000 property, $260,000 debt, $230,000 cash in offset. So they've just about offset all of the debt, and there's nothing else inside of there. They mentioned the property hasn't gone up at all in 6 years, and the rental income is $26,000 per year. They've also got a house newly renovated on the Gold Coast worth $1.2 million. They owe $900,000. The rental income's about $60,000. It's owned through a family trust. This person makes the comment, we can't claim the interest and the land tax is high, I believe, when owned in a family trust. Yep, that's right. Only owned it since July, so I want to hold it until I retire and it grows some more. Okay. Money in offset, they've got $250,000 of cash, which is sitting in the offset account for the beach house on the Mornington Peninsula. Then they go on to mention that it looks like they're both self-employed and they run their own companies. This person has $250,000, earns $250,000, but they only pay themselves $120,000 because they're trying to build up the cash in the company. The partner is on about $200,000, only pays himself $120,000 because he's also trying to build up cash in the company. And then they also mentioned they've got $200,000 invested in a joint venture in Melbourne, which is a new build. It'll sell in June 2025, and the profits will be around $50,000 to $250,000 coming back to you. They also mentioned they'll inherit about $1 million in shares and cash from their elderly parents, probably in the next 3 to 5 years. Paraphrasing here, they kind of want to work less. They're considering selling the apartment inside the super fund, deciding what to do to get more cash in the SMSF. So how do they build up the super fund? They want to retire in about 5 years in 2030. They have a child, 8 years old, got private school fees there. So they think they need about $250,000 put aside for private school fees. And they'd like to retire with an income of about $200,000 per year. Yeah, just questions around what do you think we should do? How do we get more money into super, etc. So if I just add those numbers up together, just to sort of summarize things, because there's a lot of information there. By my calculations, you've got about 5.3 mil roughly in property. So that includes the property inside super and this joint venture that you've invested in. You've got about 1.7 mil of debt, including the debt inside super. You've got 250 cash against the beach house, 230 cash in super. So your net asset position, including super and everything, is roughly about 4 mil. So look, that's good. So that you've done well there. That's a pretty strong net asset position. Really, I think the difficulty that you're going to come into here is liquidity and cash flow. And all of your asset, you're in one asset class, property. So you don't own any shares or any other investments of any kind. I guess, I don't know whether your companies hold any value to them. I'm not sure, but potentially that's some value to that, which is not property. But really, otherwise, you're 100% in property and you've got a bit of debt there. But overall, the loan to value ratio, it's not outrageous. But yeah, I think what you're going to find is just a bit of a cash flow and liquidity issue. So look, in terms of the super fund, so net assets of 500,000. So that's 250,000 each in the super fund. I'd say that's relatively low relative to your overall net asset position and your wealth and your incomes. I'd say that's low. I think, and look, this is often a trap that self-employed people get into a little bit. They put super to the wayside. But look, you got 500,000 in there combined. I think you really need to start building that up. The aim of the game should be to really build that super fund up over the next 5 years before retirement, and then even into retirement. You want to make the most of it and really try and get money in there. And you want to build up shares. I think I would almost go and invest the cash in shares inside the super fund. This ties back to the earlier part of my podcast talking about needing to build up the liquid assets, invested assets in the super fund, and leaving some leverage is okay on the property. I would probably invest some of that, but I would also then just work really hard to try and pump as much money into super as you can. So concessional contributions, I'd look at, definitely maximize your concessional contributions. 30,000 per year is what you can do. Your balances individually are under 500,000. You're 250,000 balance each, which means that you could use carry forward concessional contributions. So what this means is you can look backwards 5 years, and if you haven't contributed up to the concessional cap, the gap, the unused cap, you can access it. I'd really sort of have a look at using those, I think, to get more money into super, then potentially even non-concessional contributions. Again, I don't know what's possible dependent on your cash flow. I don't know what your living expenses and everything are. And to be honest, there's quite a bit. You've got a bit of a complex situation. I guess enough complexity that I can't really work it out. I'd have to run some projections and modeling to really try and work out what your surplus cash flow position is and therefore how much money you can put into super. But I guess I'm just giving you the options and tools here of things you can look into. Look, selling the property inside super, again, I can't really advise on it because I don't know with any of these properties what they're like as assets. You've told me how much they're worth, what the debt is against them, who owns them, and where they're located in terms of Melbourne or Mornington Peninsula or Gold Coast. That's really, it's kind of not enough to go off in terms of, we'd need to actually understand what's the quality of the actual investment. Where is it located and how does it stand as an investment? So, yeah, I don't think I can really advise in terms of which property would you sell. But look, I don't know, the apartment in Melbourne in the SMSF, it'd just be generally speaking about the Melbourne apartment and unit market. I think it'd be a real shame to sell it at the moment. It's such a discounted or undervalued part of the market. I think it'd be a real shame to sell it, but then again, I don't know the specifics of your property. Your trust, so that owns the Gold Coast property, so that would be running at a loss, I'm sure. I think you've mentioned that before. So look, I think you should start investing it. So losses get trapped in the trust. It's kind of one of the downsides, along with the land tax that you mentioned there. But losses get trapped in the trust. They don't get trapped forever. Once the trust eventually starts becoming cash flow positive, it can use those losses. They're carried forward. But for the time being, the losses do get trapped in there. They don't get to negatively gear or offset against your personal income. They stay within the trust. So look, I'd be, you really want to get that trust, if possible, cash flow positive. So perhaps it's a strategy maybe with the inheritance. So when you receive, $1 million in the inheritance, you're not going to be able to put all that in super in one go. I think putting some of that into the trust, so build up a liquid asset, so some share portfolio inside the trust to try and get the trust running at, cash flow neutral, I think would be a good idea. And then if it ever got really cash flow positive, you could use a corporate beneficiary. So that's a company which is a beneficiary of the trust, so that if you're both in the top tax brackets, I'd think, so, you can use a corporate beneficiary to sort of cap your tax rate at 30% rather than paying a higher tax rate in the top tax brackets. The other thing I'd make a comment on the joint venture of this property. I think you mentioned that you'd invested 200,000 and you're hoping to get a profit of around 50,000 to 250,000. Sounds pretty lofty. I'm not sure what that is. It sounds like maybe a bit of a new build development. Yeah, I think to invest 200,000 and to get a profit back of 250,000. I hope you do. That sounds a little bit lofty, but look, I think if you've got the opportunity, I'd get the cash out of that if that's what the profit that you get or whatever it is. You need the cash, more importantly. I think that you need the liquidity. So particularly just with your upcoming school fees and all these things, trying to pump money into super. So I'd get the money out of that. The Melbourne apartment that was bought with cash in the company, it's probably not ideal, but that's okay. Perhaps that's one if you had to sell anything because it's in the company. I mean, you don't get the CGT discount when it's bought in the company, but it does allow you to really cap the capital gains, and then you can retain profits in a company, and then you can distribute them later as dividends or distributions once you're retired. So maybe that's something to consider, is that you can sort of cap the amount of tax that you'd have to pay on the sale of that, depending on if there is much capital gains. With the Peninsula property, so I don't know whether that's on principal and interest or interest only, that loan, but I'd consider going interest only on it. You just want more cash flow. So look, I think it's probably still negative cash flow at the moment, but it's probably getting close to cash flow neutral, I'd be guessing. I don't know what the expenses are. But so, look, I think generally the aim with investment properties in general, and particularly your one with the Peninsula property, is just to get them to cash flow neutral. Don't have to pay off 100% of the debt, I believe. You're much better just going, put it on interest only. It's probably going to work its way, I'd think, over the next sort of 5-10 years to getting cash flow neutral. But then with the funds that you would have been using to pay down the debt, you need to go and invest them elsewhere, I think, to build up your liquid asset position. I mean, that's going to be better from a tax perspective because, you put more money into super, you're not going to get taxed on the income from that once you start pension, but you are going to get taxed if you completely pay off the debt against your investment properties. The rental income you get taxed on. So I think it works from a tax perspective, but it also just works from a liquidity and diversification perspective. The other thing to think about, I don't know what your companies are or how much they might be worth, but if there is a value to your company and if you're potentially considering selling either one of your companies, because I understand you both have companies, there's another way there of putting money into super. So there's some small business concessions, which some of the small business concessions are really good. One of them is called the retirement exemption. So what this is the capital gains from selling a business, you can clear, basically offset or clear by making it an additional super contribution. And so you can do up to 500,000. It's a lifetime limit. So if you had a capital gain of 500,000 from the sale of your company, you can put that into super and it will clear that $500,000 gain. And this cap, it's separate to all the other caps. So separate to the concessional, non-concessional cap, all of the others, it's a separate one. So it's just another avenue, perhaps something to consider that could allow you to get more money into super and really boost it up, which I think you need to do. Okay, so in terms of your retirement income of 200,000, look, it might be possible. I don't know. As I said before, you've got enough complexity in your situation. I'd have to spend some time doing, projections and modeling to really sort of work it out. But I think that might be possible. But I think it's going to require selling a property or two. And, I think in the short term, really, you want to delay doing that as much as possible. A, to retirement, because it's going to be better from a tax perspective. B, because the majority of your properties are in Melbourne and that's been a bit underperforming and be ashamed to sell at the moment. And C, you just generally want more time in which you are forced to sell the property, which kind of ties back to what I was talking about earlier. So, anonymous listener, there's a bit of complexity there, and I hope that helps. Just some considerations that we think about. And again, this is general advice. It's that I'm sort of just giving you general considerations to think about. It's not personal advice. It can't be. So, look, I hope that helps. Okay, and I've probably got time for one more question. So, the last question is from Jeff. Jeff writes, since value appears to have underperformed growth for a period of time, is it a reasonable assumption that growth is getting overvalued, especially measured by the NASDAQ? Can you name a couple of high-quality, low-cost, value-based index funds, preferably funds that can be bought on the ASX, but track US stocks, Aussie, and the world? Generally speaking, of course. Perfect, Jeff. This is all general advice, of course. Thanks for putting the podcast together. No worries. Okay, so look, Jeff, I'll give you a few options here for something to look into in terms of investment options that are more value-based rather than growth-based. I would probably agree with your sentiment there, your assumption around growth getting overvalued, by the way. It's been on an incredible run. There's always this sort of, battle between growth investing and value investing, or just a comparison between them. If you go back a really long period of time, you've probably heard Stuart talk about value investing's outperformed. However, in the last 10 years, growth has way outperformed value. But look, the tides might be turning because things do look quite overvalued there. So look, to give you a few examples of ones, Vanguard offer an ETF, which is available. It's an ETF, so it's a listed stock. Its ticker code is VVLU. So it's the Vanguard Global Value Equity Active ETF. VVLU. That's a good one. Look, it's a low management fee. It's 0.28%. It's from Vanguard. We're very well known. The thing just to be aware of here is, it's not quite active management. It's not stock picking. It's not, even though it's got active in the name of the ETF, it's still a rules-based approach. So it uses sort of quantitative modeling, and it basically screens the entire index and takes a rules-based approach to then just select or screen out some and then just hold the stocks in the index that have lower prices relative to their fundamental measures of value. So they look at things like price to book or price to earnings ratio or price to operating cash flow. So it's still rules-based. It's getting towards active management. I mean, really, traditionally value management, if you think about sort of Warren Buffett and Berkshire Hathaway, he was sort of one of the pioneers of value investing. I mean, that's kind of gets to active management there and stock picking. But I think the way that Vanguard are doing it is they're just looking at a few key metrics or quantitative analysis, screen the entire index, screen some out that don't meet that, and then invest in the remaining. So, look, it's a low management fee. It's still quite good from that perspective. It's not, it hasn't got the high management fee that an active fund manager would. So that's a good one, I think. Another one to give you is by Van Eck. So it is VLUE, and it's the Van Eck MSCI International Value ETF. So this one's got a pretty reasonable fee as well at 0.4%, still quite diversified, low cost. So it's got about 250 stocks in it. And really what they do as well is it's really about that screening of the market and applying a quantitative approach to the index. So they look at high value scores relative to sector peers as a measure by MSCI. So what this means is they're looking at similar things. So the price to book value, the price to forward earnings, and then another one they look at what they call enterprise value to cash flow from operations. So really what it means is they're just looking at that same approach. They're screening the index and just to focus on ones that present good value opportunities. And look, one final one that I'll give you, Jeff, is a little bit different here, but it's one that we've been, having a look into and we're curious about. So it's called GARP, G-A-R-P, GARP. That's the ticker code. This one's run by Global X, the ETF provider. It's quite a new ETF, and look, I'm not sure about it at the moment, but I just wanted to present it just because it's interesting. Look, it was only inception in September this year, so as an actual product, it's new, but the methodology and the theory behind it is quite old, like it's got a long sort of time frame, the idea behind it. So what's GARP? So GARP is growth at a reasonable price. So what this means is it's kind of a blend, I guess, between growth investing and value investing. So this idea or methodology was popularized by a guy called Peter Lynch. So there was a really good article, Jeff, if you want to read it, in the AFR on the 30th of October about GARP, G-A-R-P. Have a look at that. It's a good read. This Peter Lynch, he was a very famous wealth manager. He worked at Fidelity many years ago. He also wrote a book called One Up on Wall Street, which is a good book. So he, I guess, popularized using something, the PEG ratio. So rather than the price to earnings ratio, which is a very common metric that a lot of analysts look at, it's the price to earnings ratio divided by its growth rate. So the PEG ratio. So, I mean, this is a bit of a different one. I guess it's a blend of the two. I guess that's why I wanted to present it to you as an option. I think it's an interesting one to have a look at. We're looking at it. We think it's got, I guess, merit in its approach. It's still a reasonable fee, this one from Global X. But yeah, I thought I'd mention that one. So I hope that helps, Jeff. All right, that's about all time that we've got today. I hope you've enjoyed. I'm going to be joining you for one more podcast next week before Stuart comes back and joins you after that. So until next week, bye for now.